Welcome back to European Markets. I'm Peter Schaffrik, and today is the 24th of February 2023. Today, I'd like to talk about what I think is quite a shift in sentiment that we've seen, particularly over the last 2 weeks. And if that was to continue, it would have significant impact on market pricing. But before we talk about that, let's quickly recap what happened since the beginning of the year. I think the market has to price 3 distinct scenarios, and they're all represented in the chart that you're currently seeing. On the left-hand tail, we have to price a recession with a certain probability. On the right-hand tail, we have to price a much better economic scenario and stickier inflation. And then in the middle, we have to price with a decent probability the desired outcome of central banks, a soft landing, where inflation returns to target without the economy crashing. Actually, what I think has happened since the beginning of the year, and for the first month, is that we've squished the tails and priced higher odds of the desired outcome. And you could see that in market pricing. The rate market has stabilized, implied volatility had come down, credit spreads have come down, and the equity market has stayed quite resilient. Another implication of that is that the market almost has to price rate cuts at some point. And the reason for that is because A, we have to price to some degree that there's going to be a recession. But secondly, even in the more benign scenario, the central banks will be able to return interest rates from restrictive to more neutral levels. And you can see that in the charts that are currently displayed on the left-hand side for the ECB, on the right-hand side for the Bank of England. We've priced a decent amount of rate cuts over the course of 24. However, what we've also seen is that the more the market priced higher terminal rates, the more rate cuts were priced. But that, I think, has changed over the last 2 weeks. What you're seeing in the encircled area in the next 2 charts here is that over the last 2 weeks, the market has pushed the terminal rate higher, but has also shifted the probability of rate cuts down. So we have less rate cuts priced in now than we had 2 weeks ago, despite having shifted the terminal rate higher further. What is going on? I think what we've seen is we have seen a decent amount of data that indicates that the economy is rebounding. The 2 charts that you're currently looking at are the PMI data that came out earlier this week for both the Euro area as well as the UK, which are now almost exclusively back into expansionary territory. In the meantime, the inflation data that has come out has confirmed that inflation is falling on the headline level, but on the core level is still rising. And that's irking central banks, of course. So I think what that symbolizes, if we go back to the charts that we've looked at the beginning with the 3 scenarios, that the market has started to shift the probabilities further to the right, where the economy is much more resilient and where inflation is stickier. Now, what are the implications if that was to continue? Well, first of all, that the implied rate cuts that we're currently pricing probably won't be realized, and the money market curves need to steepen. Secondly, that means that for the rates market, it might still be a bit more volatile than we would have expected. Yet, because the economy is going to do well, that means that the riskier assets, equity and credit, can probably still perform quite decently. We think the next coming weeks will be quite crucial, particularly for the rates market, if we can break out of the ranges that we've been trading in since the beginning of the year. And I'm pretty sure when we record the next session, we will have an answer to that question. And I hope to explore it again together with you.
This content is based on information available at the time it was recorded and is for informational purposes only. It is not an offer to buy or sell or a solicitation, and no recommendations are implied. It is outside the scope of this communication to consider whether it is suitable for you and your financial objectives.